Have you ever wondered how pharma companies decide which drugs to develop and which ones to drop? Today, we're stepping into the world of pharma portfolio management, where you'll decide how to allocate resources across a pipeline of drug candidates. It's a game of risk versus reward, and your decisions could shape the future of your company. Let's get started. You're the head of the portfolio strategy at a mid-sized pharma company. You've got 5 promising drugs in your pipeline and £500 million to allocate. But here's the twist. While the combined development cost of all 5 drugs happens to match your budget, investing in all of them may not be the wisest choice. Your challenge is to balance risk, reward, and strategic alignment. Can you build a portfolio that maximizes long-term value for your company? To help you decide, let's take a closer look at the pipeline. Drug A is a phase 2 study for oncology. It will cost you £100 million to develop and has a 50% chance of success. If it makes it to the market, it could achieve peak sales of £800 million. This drug is a first-in-class therapy addressing a high unmet need. While there's substantial opportunity here, there's also high uncertainty. Drug B is currently in phase 3 for a cardiovascular disease. Will cost you £150 million to develop and has a 70% chance of success. Its peak sales potential is £600 million. It's a relatively solid candidate, but it faces moderate competition, and its differentiation from existing treatments isn't particularly strong. Drug C targets a rare disease and is currently in phase 1. It will cost £50 million to develop and has a 30% chance of success. The peak sales potential is £400 million, and it benefits from orphan drug status, which means fewer competitors. If successful, it could be a game changer, but it's still an early stage gamble. Drug D is a preclinical candidate in neurology. It will cost £80 million to develop and has only a 20% chance of success. However, the peak sales potential is £900 million if it succeeds. The early data looks promising, but the drug is still in its infancy, so the uncertainty is really significant. Finally, Drug E is in phase 2 for an immunology indication. It will cost £120 million to develop and has a 60% chance of success. Its peak sales potential is £700 million, and while it faces moderate competition, it has a strong mechanism of action that could help it perform well if it makes it to the market. A good place to start is by calculating the expected value for each drug. To calculate the expected value, you simply multiply peak sales with the probability of success minus the development cost. For drug A, for example, this gives 800 million times 50% minus 100 million, which equals 300 million. Using the same formula, we can calculate the expected value for drugs B to E. Once we've done that, we can rank them according to their expected value. We can see that drug A and drug E have the highest expected value. But as you might expect, expected value alone isn't enough to guide your decision. Real-world portfolio planning is more complex than chasing just the numbers. To make smart investments, you also need to consider diversification across therapeutic areas to minimize risk, the time it will take to bring each drug to market, the competitive landscape for each therapeutic space, and the development risk of each candidate, and whether the drug aligns with your company's strategic goals. Time is another numerical component that we can quantify and represent visually, for example by plotting a 3D scatter chart like this one. You could also consider time explicitly by using the net present value concept, where you apply a discount rate to the expected cash flow to calculate the present value, like you can see in this table. However, even if you want to use the net present value instead of the expected value, there are still other components that are less tangible. For instance, drug A's first-in-class potential could position your company as an innovator in oncology, but its uncertainty is higher. Drug D has high peak sales potential, but its early development stage makes it a risky long-term investment. Drug C benefits from orphan drug designation and reduced competition, but its low success probability makes it a gamble. With these considerations in mind, let's look at some possible strategies. One option is to focus on a balanced portfolio by investing in drug A, drug B, and drug E. This approach diversifies your investments across oncology, cardiovascular disease, and immunology, offering quicker time to market and solid expected value across the board. While you are heavily invested with a total of £370 million, you're also left with some money to spend on future assets should new opportunities arise in the future. Another option is to take a high-risk, high-reward approach by backing drug D and drug C. While this strategy has significant upside potential, it also comes with high levels of uncertainty and longer development timelines. If things go well, you're spending a total of £130 million in exchange for an annual sales of £1.3 billion. A bargain if you're lucky, but also highly risky. Alternatively, you might choose to mix and match or even decide not to invest the full 500 million to preserve financial flexibility. What would you do? Let me know down in the comments. Drug portfolio planning is rarely straightforward. The industry is dynamic and decisions often need to adapt in response to new data on market changes. For example, what if drug A's success probability drops to 30% after phase 2 results? What if a competitor launches a similar immunology drug, cutting drug E's peak sales potential in half? What if drug C receives breakthrough therapy designation, accelerating its approval timeline by 2 years? How would these changes affect your portfolio choices? Pharma portfolio planning isn't just about chasing the numbers, it's about managing uncertainty, aligning with strategic goals and positioning your company for sustainable growth. Even the most promising candidates can fail, and the smartest strategy often comes down to balance and foresight, and honestly, a bit of fortune telling. If you enjoyed this exercise, give this video a like and subscribe for more deep dives into pharma strategy and decision making. I will see you next time.